Welcome to episode 6 of The Compass. With you as always, I'm Derek Macpherson, chairman of Olive Resource Capital, and joining me is Sam Pelaez, president, CEO, and CIO of Olive. We're coming up on a big moment in the mining space in general. Early September, there's a couple of big conferences. As we mentioned sort of in episode 5 last week, there was a deluge of news. By the time you guys see this, we're recording on Friday, September 6th, but you guys will probably see this just as these conferences are about to start. And we'll probably get some more news between here and there as well. Companies are sort of clearing the deck so that as they present to investors, both one-on-one and to the group settings, that they can talk about everything that's out there. For those of you who don't know, we're familiar with the two conferences are the Beaver Creek, Precious Metal Summit in Beaver Creek, where you get more small caps and developers, maybe some small producers is kind of the focus there. And then you go to the Gold Forum Americas, which is run by the Denver Gold Group. And that is a much larger event, generally attracts more larger caps. There are some explorers and developers, but there is some crossover in those large developers, small producers. But generally, that's the trend. And we attend both every year. And I guess, people would say, well, and actually, I just want to say we get to go because we're investors and we do it professionally, but both these conferences offer web streams. So if there's a particular company that you want to learn about or something that we've mentioned, you can actually see that the corporate presentations that, generally Sam and I would be sitting in. You don't get the access to one-on-ones, the networking, but at least you can get, you could hear some of what these companies have to say. In a pretty condensed format. I think generally 10 to 20 minute presentations, depending on the conference. So we have that option. So why do we go? Sam, I'll put that to you first. why are we going to 8,000 feet elevation in Beaver Creek and then to Colorado Springs after that?
For us, it's an exceptional opportunity to catch up with different companies. We go primarily for two reasons. One is to find new opportunities. It's easy to get kind of trapped into your own companies that you already know about. One of the good opportunities about these conferences is to sit through the presentations and to identify new opportunities. We'll talk about one that I discovered last year that I had never heard about, even though the company had been around for a while. And that we have subsequently invested in, and the second one is just the networking opportunities. Half of the conference happens between 8 a.m. and 5 p.m. The other half happens after 5 p.m. when people go to different restaurants and bars, and you have different style of conversations. And there is a lot to learn about this. Not just rumors, but hear other investor, for example, contrast your views about a company that you met with, that you saw that you like, that they perhaps don't like. There's a good setting for those kind of things. What I would say is, and I had this conversation internally with my loved ones, is you are away from home for 2 weeks, pretty much. It's not the most popular event for families. And it is actually quite a strain to be away for those 2 weeks. Number one, because you're going to altitude in the mountains. It's a beautiful location. But, these are days that are 12 to 16 hours every single day, back-to-back meetings, presentations. Even when you are at the lobby bar having these conversations, I consider that to be work, because you're not necessarily talking about hockey. You're just contrasting views about what you like or what you don't like.
Well, I think you find out. Sorry, Sam. I think there's also you find out things that are going on, right? You find out that someone who recently left company X is all of a sudden starting a new company that you can potentially get involved in. You find and those are opportunities that are on the presentation docket or whatever, and certainly we've gotten investment opportunities through that, made money through those networking channels. As well. And I think that's a key. I mean, because particularly at Beaver Creek, a lot of the small cap investors are. So the people who invest in those companies, create the companies, and and then operate those companies, right? And so those are becomes really key. The other thing that is unique about these two conferences that is different from what I would say is, say, like a PDAC or some of the other industry conferences, is that it is a real international gathering, right? It's one of the few conferences you get a lot of the where you actually get the funds participating or the investors participating, right? We're going, but you get a lot of the North American funds will be there. You get a lot of the European funds that invest in small caps, and so you get so it's a different conference. The other thing with Beaver Creek that is interesting is there's a lot of corporate development that happens. So as an example, Kinross is there, but they're not taking meetings with investors. They're there with their corporate development team, taking meetings with companies that they might potentially be interested in meeting with, investing in, right, or joint venturing or whatever. So I think that those are that was makes it interesting. I mean, the primary reason we go is that find ways to make money, and maybe that's investing in a new private that's starting up that we wouldn't have known about otherwise, or that's like you said last year, finding a company that we'd never heard of because we sat through some presentations and said, oh, this one's actually really interesting. And then the last is also to catch up with some of our investments too, right? Like there's an opportunity to see management teams that are based in Vancouver that you don't normally, or in other parts of the world that you don't normally get, or Australia that you don't normally see, and you can sit down with them and talk to them about what's going on, where the market is, etc. So I think those are all the reasons.
I want to add two things. One is that these two shows are pretty much exclusively CEOs presenting. There's many other trade shows and conferences where you get investor relations people come over, or the CFO. These two conferences are pretty much exclusively the CEOs of the companies presenting or taking the meetings. So you get access to obviously the very top of the company. And the second thing is the setting. Both the Beaver Creek show and the Denver Gold show happen in these particular locations where you're kind of in a way trapped. Beaver Creek has, 5 restaurants. So if you do a tour of the 5 restaurants in a single night, you're guaranteed to see 90% of the people at the show. So if you're literally looking for someone and you want to force running into somebody, you can actually accomplish that at these shows. There's no place to hide, if you want to call it that way. So that generates a pretty positive environment for the ideas to flow and to meet new people and to opportunistically run into people you're looking to meet.
And we both, as much as it is a work trip, and that's what the focus is. Obviously, it is an enjoyable experience as well to go see a lot of people that you haven't seen in the industry for probably 6-8 months from PDAC, and so it's not it's work, but it's work we enjoy, I guess, is the other aspect of it. So I guess, make this, rather than advertisement for these two conferences, to make this a little more actionable and sort of what we're looking for, right? Well, when we see company X, what are the things that, what are we looking for? I mean, the simple answer is as I mentioned before, we're looking for an opportunity to make money. Like, is there a reason that this company and this stock is going to go up? But and so that's the kind of the overriding theme, I guess. But if we look down the, what we're going to do is just kind of run down the different types of companies, what we're looking for when we see the presentations, when we meet with management, etc. So, like, I guess maybe let's start with explorers. Sam, what are we looking, besides large purple dots, which all explorers seem to have as good drill targets? What are we looking for with explorers?
This goes back to one of our very first episodes. We're looking for competent people running the company. We're looking for companies that have reasonable access to capital. Again, raising $500,000 at a time doesn't advance the company to any meaningful stage. We're looking for companies that are well supported, particularly in the exploration stage. We're looking for early entry opportunities. A reputable group that's picking up an asset and they're doing that first or second capital raise. We're interested in that. We're interested in companies that have recently had some exploration success, and now they're looking for that next $4 million, $3, $4, $5 million capital raise that will turn the discovery drill hole into something that resembles a resource. You don't get to a resource with that amount of money necessarily, but you at least get to delineate an envelope where we can ascribe some sort of tonnage and some aspirational or arm wave type resource that we can peg a valuation to.
So just before you move on, that's a really important point. I think the opportunity, because there's been such a lack of interest in junior mining companies, in particular explorers, there are companies out there that you will meet, and you'll go, okay, you've got 2 or 3 or 5 or 10 drill holes into a target. You look at it and go, well, there's there, right? They've actually started to delineate something, and they need that next level of capital to start to prove it out. But because of the lack of interest in the way the market's been, the market hasn't recognized that. And those are kind of investment opportunities where it's, it's a little bit asymmetric. You're like, well, this is a 5 million market cap company, but it's got it's already on the path. They did the hard part, right? They found something, they got it in, they put it in the box in the drill hole. And so that's important. But I think it's not just, you talked about early exit and sheep. It's how do they, early entries, which means getting in at a lower valuation. But like, how does that company go from 5 million to 50 million, right? Because that's what we're interested in at Exploreco. And that's,
for example, a good example is Salmon Resources Quebec, SRQ, a company that we've been looking at. We first heard about it during PDAC, and they have a sort of discovery hole, and they're not going to be officially at the conference, but we know there's shared management team and board members, so we're going to go out and look for them. We're going to find Benoit effectively to get an update. They're at that stage where they had like that initial drill hole that suggests there's more resource there. There's likely going to be a capital raise at some point because they need those 5 million to go and drill, the 5 or 10,000 meters that will take it from 1 or 2 interesting drill holes to a fence or a couple of intercepts in different places. So you can start identifying, okay, this may be a VMS lens, or this may be whatever it turns out to be. So this is a good opportunity to catch up with stories like that and effectively get in the opportunities as early as you can, because obviously I don't have to tell the viewers this, but that's obviously where you get the highest opportunity for return.
It also de-risks your investment, right? I think, if you're investing in Exploreco that has something at a $5-6 million valuation, stocks can go to zero, right? Let's not kid ourselves, especially exploration stocks. But that if you're investing in a 5-6 million market cap, there's a lot of room to the upside with drilling success. Whereas, you might lose a little bit of money, but it's there. Now, it's also, you might lose a little bit of money on failure, but also the way, this is getting a little bit esoteric away from talk, but we also size to protect ourselves there, right? We don't put big investments in small Explorecos because A, you can never get out, but B, you're looking for a 10 times return. So it's a small investment risk to the Exploreco. I think that's a lot on Explorecos because that's, our focus in these conferences is the conference here. A lot of that is, the other one is, I guess the next step is developers, right? And I think this is very similar to Exploreco's catalysts, right? Like, are they drilling an area that has the potential to materially change the economics of the project or the deposit? Are they doing some test work that has that potential? Is there a study coming that might change the look of the economics? Did they just put a study out that we might want to dig more into the details with them one-on-one?
And I want to add the M&A. So, London Gold, we've been talking about potentially buying somebody. But on the flip side, Numa, who's the, second largest shareholder, keeps buying paper on the market or exercising warrants. I'm not very clear on that, but what's the update there? We want to meet with companies like Troilus. What are we doing here? Last year, this time it was very clear what the opportunity set was. We really like the company. We want to hear from management last for the next 12 months. There's companies like Fireweed Zinc, Fireweed, not Zinc anymore, they changed name, Fireweed Metals. They just put a new resource update yesterday or the day before. Again, they've been drilling aggressively this summer. What's the plan for next year? Continue drilling aggressively to take these resources from a tier 2 to a tier 1. Those are the kind of conversations that we want to have with these companies when we go to the shows. Granted, you could say you could always arrange a call with IR in Vancouver and get that type of information, but it's different when you sit in person with the CEO and you get that kind of additional feeling from the conversation beyond the explicit words that they're sharing with you. The company that, the developer that perhaps that we mentioned earlier that I discovered last year is Bravo. We discovered them last year at the show. We met with them at PDAC. They came to our office. Since then, they already have a pretty sizable nickel PGN resource. Since then, they've had a new discovery on site that appears to be some nickel copper sulfide that could materially not change, like dramatically improve the outlook for the company. So that's another company that we want to meet with again, get an update.
And that's, but actually, on Bravo, that's an interesting one, right? We from how we approached it, right? That's when we saw in Beaver Creek. We're like, we sat down. We both sat in the presentation. We said, "Wow, this company is really interesting." And then we looked at the valuation and went, it's interesting, but it's expensive. We like the company, and so, but we put it on our list. We put it on our watch list. We watched it. We saw the stock came down. Materially, we looked at it and went, okay, nothing's really changed. We bought a little bit. We met with the CEO. We bought some more. And then they made this discovery, right? So we found a good company. We followed it. We waited for an attractive entry point. We're patient on the entry point, which I think is an important thing for a lot of investors, right? We didn't buy it when it was at its peak. And now we've traded around that position. We've made money on it, right? So I think, and those are the opportunities. And, people say, well, it's expensive to go to these conferences. That one investment, and that wasn't the only thing that we bought out of that conference. That one investment more than 5 times paid for our trip, right? That trip last year. So I think that's another kind of
another way to see the expense. We see the conference expense as an investment.
Yeah.
And our job is to get a return on that investment that far exceeds our compensation, our costs, but also the additional cost of going to these conferences. And historically, we think that it pays multiple times over when you attend these conferences, and you get those inside scopes and the presented with new opportunities.
Right. So that's kind of that's kind of explorers and developers. I don't know if there's something else you want to mention there, but going to the next level. Okay, now we've driven down off the mountain at Beaver Creek. We're at Denver, and now we're looking at more producers, junior producers and mid tiers, and majors. So there's 2 aspects in mid tiers for us. One is, is there an investment opportunity that people are missing, right? And the second is, if they are generating cash and well valued, like a Lundin Gold as an example, are they going to go out and buy something, and then what fits their acquisition profile, right? I think a major takeaway from us from last year, I think there was 3 or 4 mid tiers that had sort of turned the corner in their own development and started really generating cash, and they were Centerra, Dundee Precious Metals, and Calibre. And we kind of said to ourselves, well, those 3 companies are going to go out and buy something in the next 12 months. No one ever really says they're going to buy something, but you look at the balance sheet, clean balance sheets, generating tons of cash. Lundin Gold was in that camp as well for us. And we looked at it, and they said, that all made sense to us. And then, lo and behold, Dundee took a run at Asino, Calibre bought Marathon Gold, the Valentine Lake. Centerra hasn't done anything yet. I suspect that that's still a likely scenario. And then you kind of extrapolate that and say, okay, well, Dundee still has to buy something. So what are they going to buy? What are they looking at? You try and get hints of that from your from the what fits their profile. The other thing though in mid tiers, and maybe Sam, you could talk about this because we have investments that are like this, is unrecognized growth.
Yeah, that's actually my favorite investing space, particularly in gold. And maybe if we go back, like when I worked with Ralph on US Global, that was Dundee Precious for us. Dundee Precious was always a complete misunderstood company by the market. They were generating cash flow. They were plowing it back into their own operations, improving them, making them better. They had baked in all of this growth that the market had not recognized. And we were shareholders when the stock was $1.80. I think the company is worth $13 today. That's, call it 8 years ago. That's a phenomenal return on a company that's never really had any material amounts of debt, always had good management teams, good shareholders, etc. So where do we see those opportunities today? I think a plain, easy one in the mid-cap space is K92. They have multiple expansion opportunities at their site. A big portion of that capex has already been sunk in. There was a big fear last year that they had to do a dilutive capital raise that didn't happen. That provided a good opportunity for us to enter into the stock. And they're going from 100,000 ounces to 300,000 ounces in the next 18 months or so, with a plan ultimately to go to 400,000 to 500,000 ounces. That becomes that's sort of like a Fruta del Norte in London Gold. London Gold is a $6 billion market cap. K92 is about $1 billion. So there's your re-rating opportunity that should have no dilution factor in the process. So we like that one. The other one in that space that we like is Aris. They're turning their Segovia facility from 200,000 ounces to 300,000 ounces. Very good margins there. They are building the Marmato deeps. That's going to be another, call it 200,000 ounces. They have the Soto Norte project now, or the majority of it. They bought from Mubadala. If you go back maybe 10 years ago, that used to be Ventana that was sold to Ike Batista for an obscene amount of money. But this company has a track easy to 800,000 ounces over the next, call it 5-6 years. The Marmato is fully funded. The Soto Norte isn't, but with the 500,000 ounces of production, the cash flow generation is going to be more than enough to fund that subsequent growth. And at the risk of overextending myself, our favorite large cap is Anglo Ashanti. In my mind, they have turned the corner, phenomenal management team, but beyond that, they have baked in this incredible amount of growth potential in Nevada with the acquisition of Silicon that the market is completely not recognizing. If you look elsewhere, Origin, that has a royalty on a portion of the deposit, has gone from 38 cents to $1.38. Meanwhile, Anglo Ashanti keeps trading based on its existing operations, and nobody's adding any premium or value for this development project that they already own. That's going to be, based on whoever wants to talk about it, that's certainly more than 10 million ounces at pretty good grades in one of the best mining jurisdictions in the world.
Sam, it's already north of 10 million ounces, and that's 100%. Like the plus 10 million ounces that produce more than 500,000 ounces a year in tier one jurisdictions generally are very hard to come by, and generally are not something majors discover in their own portfolios. And a lot of the silicon was something, they've consolidated the ground around silicon. They acquired Corvus, they acquired what was the original land package of Northern Empire from Coeur. They've done, they've sort of rolled up the area, but the real discovery is at silicon, and that's plus 10 million ounces on its own. And I think that I think that's misunderstood.
It's just not valued.
Yeah. I know it is going to be, it's going to be in production sooner rather than later, because they did acquire part of the Chorus acquisition was actually something that's permitted, but it's not. It's going to take time to get up to that full, probably 500,000 ounces plus a year run rate that asset's going to be. But yeah, probably one of the best mining jurisdictions in the world.
I mentioned Dundee Precious because it's still around, but another one where I did this with Ralph at US Global, and we were very successful, was Saracen in Australia.
Right.
That stock was somewhere between 30 and 45 cents Australian for the longest time. We were building these two operations, Kara Sudan and Thunderbox. I went to site, I remember, with Bono. He was also a shareholder. And it was just, this is incredible. 12 months after that, the story was already $2. And I think ultimately it went to 365. It was a 10-bagger in a 3-year period with the exact same characteristics of the opportunity that I just mentioned, which is completely underappreciated growth that's already baked in and that you don't need any dilution for to materialize.
Yeah, I think that's a key thing, and especially in a market where necessarily developers and explorers aren't getting that recognition, where there are historically bigger returns. This is an investing area, and we could probably list off a bunch of companies, but that fit that category. It's one of my favorite themes when I was a research analyst. Lakeshore had that theme. Claude Resources had that theme before they got taken out. Crux and Lake had that theme when George Ogilvy, who's at Arizona Sonora now, first took over, like fundamentally moving that production without taking in more money. But that chat about Anglo is a nice segue into the majors. One of the things historically that we do at Denver is you'll find us at a table watching all of the majors present. They present on Wednesday morning and they're all there. Tuesday morning, sorry. And they go back to back to back. And so, what are the key things we learned? I guess I would describe as it 2 years ago was probably was when we learned it, right? Is that all of them stood up there, with the exception of B2, who said they were going to buy something and then did in Sabina. They all stood up there and talked about drilling near their existing assets and the low cost of discovery at the existing assets and adding ounces and reserves that way. They all talked about shareholder returns and capital discipline and optimizing their balance sheets, reducing debt and paying dividends, etc. Almost like they thought that as gold companies, they should be real businesses, which I think is a theme that has started to permeate, and it's something that's changed over the last 10 years, is that to attract general investors, they actually have to be real businesses. They're not proxies for gold anymore, because that's the GDX, the GLD. There's other ways for that general investors to get proxies for gold. And I think that was a key learning for us, because what it meant to us in particular was that the hurdle rate for M&A suddenly got a lot higher. Is that, you had to be a tier 2 or better asset, which kind of, if it's an open pit asset, you're talking about 3 to 5 million ounces at 2 grams. Tier 1, tier 2 type cash costs, 200, 300,000 ounces a year. That sort of became the magic number, as opposed to when I started in the business, everyone kind of was looking for 1 million ounces. So 1 million ounces gives you 100,000 ounces a year. That was kind of that would get you taken out as a developer, which clearly isn't the case anymore. But so it'd be interesting to hear what they have to say. Obviously, at record high gold prices, what they have to say.
Yeah, so I think there is no better opportunity anywhere to get a read of the state of the gold market than sitting for those 3 hours that Tuesday morning at the show, because you're gonna get Barrick, Newmont, Agnico, Anglo Ashanti, Goldfields, 10 of them in a row, telling you their own version of the same story. And those 3 hours, you're going to get like this framework of what these companies are doing, what they're thinking, how they're going to proceed. And that informs everything that happens in the market from there down. Like except 2 years ago, it was all about being shareholder returns and capital allocation, meaning very little M&A. We have seen very little M&A from the majors. If you see, Calibre was the one to acquire, Dundee Precious, not from the seniors. We haven't seen, other than maybe Kinross and Great Bear, but that was already 3 years ago, 3.5 years ago.
That was before that was before that meeting. And then there was
B2 and Sabina.
B2 and Sabina.
We haven't seen any major material, and Newmont and Newcrest, that was already 2 or 3 years ago as well. So
like a year and a half ago, but yeah.
So I think what we're really interested about is hearing what they have to say this year. Last year, the whole conversation was about discovery ounces on their own existing operations. Obviously, the best one in that was Agnico. What they've done in their own operations, and in particular at Detroit Lake, is incredible, which means they don't need to go out and buy anything. They will only buy something if it makes sense, meaning they're not going to go out there and pay 100% premiums, go and get into bidding wars with other majors for assets. So it changes the dynamic for the developers.
You have to find something that's as good or better, right? Agnico, and that's a good point, right? And Agnico's maybe the exception in that large cap space. Agnico and Anglo probably are the exceptions where they have really high quality development projects in their portfolios, or have demonstrated an ability to expand their own operations. There's a limit to that, obviously. Detroit can only get so big. Malartic can only get so big. But if you look at Barrick and Newmont didn't buy Newcrest because it had a great, bought Newcrest because it had a better pipeline of growth, had a better lower cost asset base, right? That was the logic. Barrick, obviously we've all heard that they've missed out on things, or they've been too aggressive on price and missed things that they wanted. I think that's Bristow's talk, I think, is one I want to hear. Is he still on the copper theme? His first quantum on his list of things to buy. So I think that's an important, I guess for me, that's an important element of what's gonna be said.
So yeah, you're right. Also, 2 years ago, there was a big conversation about diversifying into copper. Right?
Yeah.
Newcrest had that. Yeah. So the allure for Newmont was also that they could get some access to copper.
Yeah.
Barrick has talked about it numerous times.
And there certainly are rumblings that Barrick tried to take a run at First Quantum, which it looks like that almost happened prior to the appropriation and prior to
a Panama situation. Yeah.
Yeah. But so I think those are. That's what we're looking for. That's what we're going to be focused on. Over the next 2 weeks. Next episode is going to be filmed live from Beaver Creek. I think Matt might actually join us, so we'll see what see what happens. And the episode after that will be sort of a wrap up of all the conferences and what we saw and what we like and what we don't like. Then maybe we got to get a little more on the things we don't like. But thank you everybody for watching again. We really appreciate you guys watching. We appreciate your feedback and comments. And if
there's a particular company that you are really interested in, put it in the comments. We'll see if we can meet with them, and we'll give you our view. We'll give you our views on the company and the valuation, etc., and whether we would invest, whether we're invested, whether we wouldn't invest, and the reasons why. That way we can start conversations about these things.
Absolutely. All right. That's a great idea, Sam. Thank you, everybody, and we'll see you next week.
We'll see you from Beaver Creek.